So you have to understand that once you have a good idea, do not get married to your idea. You should talk to at least a few people around yourself who you trust, who will give you an honest feedback about the challenges, questions, and problems that you have. Once you know that, try and write it down. Ritesh from Oyo says that every founder must write down those fundamental questions. What's the competition like? Why will you be successful over anybody else? Will you even be making money while doing this? Will people pay you for this? Why are you the first person who will try and make this happen? If somebody else tried it, why did they fail? A lot of these questions will come about and you may not have the answers for that, but attempt to write them down for the first time. Secondly, the average concentration time for any individual is not more than 3 minutes. So you have to ensure that your pitch is crisp, precise, and to the point. You should clearly tell what problem exists and how are you trying to solve a good problem. Your idea or product should be demonstrable and your valuation must be fair. Most founders make this mistake of starting with industry sizes, how big and scalable the venture can be. Trust me, a good pitch is one where you just talk about your vision for your company for the next 6 months. Do not go overboard. Just tell them how you will scale organically with your existing resources. These investors hear about industry and market size from everyone, so they do not want to hear that from you. Your pitch has to be authentic and real. You have to gain the trust of the investors because they are the ones who are going to put real money in your venture. After every pitch, make sure you ask one question. What did you think about my pitch? What did I do well? And what could have I done better? सिर्फ 3 मिनट है तुम्हारे पास, तो आओ दोस्तों अपनी जिंदगी की सबसे अच्छी पिच करें. One thing you must remember that a good entrepreneur is successful no matter what. So investors will always choose to partner with good entrepreneurs so that they can also make more money. Now, would you change your pitch when you're asking for, let's say, $1 million or $1 billion? Remember, when you're asking for $1 million, you are selling a story. But when you're asking for $1 billion, you are selling a mission to disrupt the market, to become the market leader. So data is most crucial. You have to have a solid execution history. The model must be an amazing scalable model. Otherwise, you cannot raise $1 billion. You have to demonstrate that your top line has grown from 0 to 10x to 100x to 1000x. Don't worry if you're cash negative, but you have to sell it to the big guys that those negative cash flows will eventually become positive if the company receives the positive investment. Amazon had been in loss for the longest time, but look at it now. It owns practically every space it ventures into. Always remember that investors need you as much as you need them. Getting the first investment is the most difficult part because those guys are the ones who are taking the maximum risk and putting their own hard-earned money into your venture. The common notion is that getting a big ticket investment from a venture capital is far more difficult than getting an investment from an angel. But that's not the case. VCs invest other people's money, so they have an investment target. But they will only invest in most of the cases where there has already been an angel or seed investment by someone else, as opposed to an angel investor who is a true angel in the sense that he is actually just believing in your idea. He's believing in the promoter, knowing very well that out of 10 startups, 8 will fail, but the 2 that will work become unicorns. Thank you.
Term sheet is 10 to 15 page document containing very broad terms around which the investment is proposed to be made by the investor. It covers 5 broad points. 1. Instrument in which the investor proposes to invest, that is pure play equity, optionally or compulsorily convertible preference shares, optionally or compulsorily convertible debentures, or pure play debt. The second, amount of investment proposed to be made by the investor. along with payouts of dividends or interest attached to the instrument. The third, rights available with the investor once he invests money like vote seat, veto rights, affirmative voting rights, some drag-along, tag-along rights, etc. Fourth, the restrictions set out for the promoter like cap on remuneration, lock-in of shares held by the promoter, etc. And fifth, exits and or payouts for the investor along with their proposed timeline. This term sheet signing mostly eventually paves way for a due diligence conducted by the investor on the company, which subsequently leads way to the investment in the company and signing of all important shareholders agreement. Negotiation with investor is a skill. This skill can be innate or can even be acquired. It is important to understand that you're not only selling the business, the idea, but also selling a part of your future. So you have to be very careful about how much to ask and what to ask. Stake dilution is not a problem. Over dilution is a problem, yes, and no dilution is an even bigger problem. As an entrepreneur, you should make the investor understand that over dilution can actually be counterproductive for the investor, as it will reduce the skin in the game for the entrepreneur. So the problem is that the entrepreneur may resist going for further rounds of funding when required, fearing further stake dilution and an eventual employee type status with lesser drive and motivation. Besides business success of the venture, negotiating with investor is an equally important process. Coming to the flip side, what if you don't dilute? Well, you either end up not taking up any money or end up taking debt. If you don't get money, the idea takes its own sweet time and may never become the next big thing. If you take up debt, you end up paying the investor when in fact you should need more money for your business to get going. Besides dilution, while negotiating, you need to also analyze what the investor is bringing to the table. Is he a strategic or a financial investor? Can his presence have a marketing impact or maybe onboard other investors now or in future? All this is a complex analysis and there is no one answer around it. You need to develop a skill to make the investor understand your idea and vision about the business and your zeal around it. You need to strike a balance between funding to be received, stake to be diluted, what skill or marketability is the investor bringing to the table. So as an entrepreneur, negotiation is the key.